In a previous video, we learned that ISA 500 sets the fundamental rule: obtain sufficient appropriate audit evidence. But some areas of the financial statements carry such unique risk or complexity that they need their own specific rules. That's the purpose of ISA 501, Audit Evidence, Specific Considerations for Selected Items. This standard directs the auditor's attention to three vital areas to ensure that evidence is gathered not just sufficiently, but precisely. Let's dive into these three focus areas. The first focus area is inventory. Because inventory valuation directly impacts the balance sheet and cost of goods sold, auditors must verify two key assertions: existence and condition. The primary requirement is that the auditor must attend the physical inventory count. This isn't just watching, it's an active process. We observe management's counting procedures to assess their reliability. We perform test counts, selecting items to count and then tracing those counts back to the client's records. We also inspect the condition of the inventory, looking for damage or obsolescence. This helps determine if a write-down to net realizable value (NRV) is required, a key link to IAS 2. If attending the count is impossible, the auditor must perform alternative procedures, but they must always try to attend a count at some point. The second area is litigation and claims. This area is critical for verifying the completeness assertion related to contingent liabilities and provisions. Companies might be involved in lawsuits they don't want to disclose. To obtain sufficient appropriate evidence, the auditor must inquire of management about known or pending lawsuits, review board minutes, legal expense accounts, and correspondence with the company's lawyers. Crucially, the auditor generally sends a letter of inquiry to the entity's external legal counsel. This letter asks the lawyers to confirm their knowledge of any material claims or litigation and provide their professional assessment of the potential financial outcome. This direct external confirmation is often the most reliable evidence we can obtain in this complex area. The final focus area is segment information, which is crucial for transparency under IFRS. The auditor must test the presentation and disclosure of this information. Segment reporting is usually based on the internal reports reviewed by the entity's chief operating decision maker. The auditor's procedures here involve understanding the criteria used to identify operating segments, e.g., product lines, geographic areas. Evaluating whether the segment information disclosed in the financial statements is prepared consistently with the information used internally by management. Applying analytical procedures to the segment information to check for any unusual trends or relationships. ISA 501 takes the general requirements of ISA 500 and applies a specific, powerful lens to high-risk areas. By mandating physical attendance at inventory counts, requiring direct legal confirmations, and ensuring segment disclosure consistency, this standard reinforces the auditor's ability to provide a sound, evidence-based opinion on the financial statements. It's a key tool for delivering high-quality, focused auditing. Thank you for watching. Like and subscribe for more similar content.